We are live. Welcome to the Portfolio Builder Premium webinar. Today is Friday, October 22nd. We've got a lot to cover. Do a shout out to the live crowd in a moment. But let's jump right into it. Portfolio Builder's high risk, high return strategy is now up 294% in 2021. And we may need to lock in gains in the next few weeks if this perfect storm continues to grow. We'll cover what's happening. But yeah, this is outperforming the S&P 500 19 times. If you're on a free trial with our program, this is the product you get access to during your 2-week trial. If you do upgrade, we have 4 products or advisories to follow. They all use the same methodology and thinking. We just go to larger markets or smaller markets to adjust risk. So October has been great to all of our clients. The big bet on Ethereum has played out marvelously alongside our oil and gas play for the high risk, high return portfolio, up 27% in October. Safe Alpha, which mimics Warren Buffett's Berkshire Hathaway, is up 16% in October. Safe Growth Pro, which mimics Ray Dalio's Bridgewater, is up 14% in October with a global stock portfolio. And then a hybrid, really combining the Ray Dalio and Warren Buffett strategies into one more exciting portfolio called Bootcamp Core, up 22% in October. So great job. And again, depending on how much money you have and how much risk you want to take, we can throttle your strategy to hit your target returns. Right now, it's a screaming buy, buy, buy trade alert for all strategies. We'll cover what's going on in a minute. But if you're catching this on YouTube and you're not live in the Zoom webinar, just realize you're not going to get the actual trade alerts and asset allocation to follow. You will need to call John at 505-610-1334 to upgrade your membership and gain access to the private membership area where you can punch in how much money you want to invest into any strategy, and it will automatically calculate exactly how many shares to buy of each ETF. Okay, so emergency investor warning. This is starting to look worse and worse by the day. My base guess is that we don't see this play out, but we need to be ready for it in case it does. So Powell just came on TV today again saying that it's time to taper. The inflation is just out of control. And the initial knee-jerk reaction was the NASDAQ sold off greater than the S&P 500. So this really is what I was thinking would be the outcome of tapering, which means the Fed's going to slow down its bond purchases, and that should let interest rates rise and should only be done if there's a strong, robust economic recovery led by labor markets and demand for energy. So our NRGU position is going to protect us against that event, which is coming up November 4th. I'm still not so sure he's really going to pull the trigger on that, and I believe it will be delayed to December or later, perhaps even to next year, and that this is really a gambit by the Fed and government to try to slow down inflation. But the problem is they have not recovered the economy or the supply chain. So you start messing with fiscal policy and monetary policy too soon, and you're going to get a very, very upset stock market, which means your UVXY position would do the job. Okay, now everything's really going to hinge on the Democratic budget, the reconciliation package. The rumor was that they were going to get the progressives and the moderates to come to terms on a $1.5 trillion headline number, but shortened the time horizon from 10 years to 5. And just overnight, we've had Joe Manchin say, no, 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 it's going to be 10 years. So that's just not going to do the trick for markets, for the fiscal cliff. Janet Yellen is screaming we need a $6 trillion budget to keep the economy on track this coming year. So we will see. Schumer and Pelosi are saying they're hopeful that they'll come to terms on a vote next week, but it's just not looking so hot. The entire strategy about how we're going to invest capital hinges on the budget getting passed. And I believe it will get passed, but it may take a market crisis to put pressure on the Senate to push this through. And they're going to have a nice way to create a market crash. I am now, I would say 95% certain this is going to occur. So what we're seeing is the medicine being used to treat the sickness worldwide works for 90 days and then completely stops. And I think this was actually well known and designed by the pharmaceutical companies, because we now have Moderna and Pfizer estimating they'll have twice the sales next year as compared to this year, and that this is really going to be never ending. So very good income source for these pharmaceutical companies. And the majority of Americans took the medicine over 90 days ago. Very few are taking the booster. So this all spells out that we're going to have hospitals overwhelmed by the end of November and extremely overwhelmed into December. This will help the big push for boosters, the big push for getting this into all the children, and could cause lockdowns to create a market crash if we have not passed the budget. So I don't think we'll see lockdowns unless the budget is not passed. And that's going to be the key thing to watch here. So it's a perfect storm dead ahead. But right now, the Fed is still printing massive amounts of money. This makes interest rates on bonds unattractive and drives stocks, commodities, and cryptocurrencies higher. So I'm actually still anticipating a melt up until the very last second when it becomes more clear whether or not the Democrats can push this budget through. So who's to blame? We have House Representatives Jayapal and Manchin are having a showdown on Biden's reconciliation bill that could cause an epic stock crash. I believe we have until mid to late November to become worried about this. The new debt ceiling will be reached approximately December 4th. So there needs to be some pretty good headlines as we approach that deadline. So very, very interesting. If we taper November 4th, fail to pass the reconciliation bill, and then go into a lockdown, I do believe that's the three magic black swans that could come together at once and create some volatility. Now, I do believe this would be short-lived, that we would want to buy the dip the second they get some spending passed and potentially get the Fed to reverse its stance on tapering. We even have half of the FOMC participants predicting rate hikes 2022, which I think are unlikely. So again, it's a big gambit by the Fed to try to get a little hawkish and slow down the inflation. But the problem is, again, we have not fixed the economy to handle higher interest rates. So failure to close a deal, and I had said in December, which is when I think it probably at the very latest would pass, and would cause a stock crash, and our UVXY position protects us against this. Now, the market's significantly higher and more leveraged, with earnings per share estimates dramatically higher than what we had in March of last year to create that epic 1,100% return in UVXY in less than 4 weeks. So we could very well likely see a greater return in UVXY if there's a policy or fiscal mistake from either the government or the central bank. Okay, some lines in the sand to get worried about would be DXY trading over 94.50. It's at 93.68. So this has been incredibly profitable for our portfolio to see the dollar falling. And I think it could go as low as 90 to 89 once we pass the stimulus. China is something to keep an eye on. Their real estate sales have fallen off a cliff due to a designed popping of bubbles in all sorts of markets. And they're taking advantage of a very strong economy to clean up the rotten parts of their economy. So emerging markets going below 48 would be a line in the sand. We're at 52 right now, so no reason to freak out about that. I do believe the single best indicator of a recession or crash will be from following the price of Brent oil. And if it dips below 75, that'd be enough of a sell-off to get really concerned. Now today we have Brent oil at 84.55, so nothing to be concerned about there. And then meanwhile, another indicator to keep a close eye on is USD CNY. That's the dollar against the Chinese yuan. If this were to devalue and head above 6.6, I would believe there's problems in China that could be systemic. Currently, it's been strengthening despite all this bad news out of China and is at 6.38. So really nothing to become concerned about. The last indicator would be the bond market having interest rates rise. That would be problematic. And so I have a line in the sand for TLT going below 140 to prepare for volatility in stocks. But of this moment in time, the TLT is actually up slightly, 0.83% today and trading at 143.75. So no reason to become bearish right now. Most likely outcome is further melt up with our exact setup. And I do believe if a true recession is coming, and not mere market manipulations due to politics, that we would see oil and other energy commodities fall, but rather energies roaring to unsustainable prices due to high demand. So this is just nothing to react to right now at this moment in time. So watching the budget get passed is critical, and watching for a sudden crash in oil prices is going to be critical. I think if you wanted to focus on only two things, that would be the two main items. My core prediction remains that we have a slow motion multi-year rotation out of growth and into value stocks. And that's how we're really positioned and doing so well across the board in our strategies. So I'm expecting a 3 to 5 year bull market in energy companies. Could be longer, but most likely 5 years would be my best guess. And here's just a look at this trend when we have similar monetary and fiscal policies. So interest rates rising typically create the crash. The crash creates a massive reduction in rates and allows for a reset. And so in 2000, it took them 2 years to begin an aggressive fiscal policy response after trying to reduce their deficit in 2001. So you got a 2-year crash in stocks. That's how important expanding debt is for the stock market. Without the government expanding debt, markets get upset. And that's really what's driving everything globally, is the growth of US debt. But again, we crash the markets, respond with heavy fiscal response. Interest rates rise all the way till 2007, and you get the housing bubble popping because of that. Oil went up the whole time, and you get this massive return in XLE from 2003 to 2008, a return of 300%. Now we're playing NRGU, which will outperform XLE 3 to 1. So we're just getting started on that one. Okay, after the housing crisis, we did not wait 2 years to expand debt. We bailed out the bad banks immediately. Nobody got in trouble whatsoever, and they did double the deficit spending of the previous cycle and began QE. They did have a taper tantrum similar to what we might be heading towards leading into 2011, which you can see in this pullback here. And then they quickly reversed that because it was clear the markets were not going to be happy with that. So we'll see if the Fed's really going to have the balls to taper into such a really weak economy that has had growth in Q4 at the Atlanta Fed dropped from 7% estimate to 0.5 and probably heading negative. Now in the next cycle, this ran up for 7 years. And then we started doing quantitative tightening and rate hikes in the face of Trump. So of course that led to a crash when we went to a lockdown, and now we're back to square one. Last year we ran a $3.2 trillion deficit. This year it's about 2.8, and they need to run a massive deficit in the coming year. Otherwise, the economy is going to have some pretty serious problems ahead. So I'm actually anticipating they will pull that off as the Democrats control 3 branches of the government. Now, when the stimulus passes, I would expect Asia and Europe to greatly outperform America. In our pro strategy, we're using EDC, which is 3 times EEM, which gives you China, India, South Korea, and Taiwan, all the big companies there, and does extremely well with a weak dollar, which I think is the main prediction we have long term. And then Europe with EFO, which does really well in a highly inflationary regime where interest rates rise. So we're really set to jet with Pro. That's my single favorite setup for the bulk of your capital, and then put a smaller amount into either Bootcamp Core or into high risk, because that's going to give you some access to cryptocurrencies. Now, Safe Alpha is great if you don't want to mess with Asia or Europe for whatever reasons. Perhaps it's moral related or politically motivated. But I do think this decade, America will underperform Europe and Asia, and that's why I've been recommending Pro so much. Here's a look. Last time we passed stimulus. Why do foreign markets outperform when the US passes stimulus? Because we import most of our goods. So this is very good news for foreign countries. It weakens our currency and drives more business off our coast onto theirs. So you can see emerging markets. Last time we passed 2 rounds of stimulus in December and February. Pushed emerging markets up 30%, European markets up 24%, and US markets only went up 19%. I do think that's about to repeat as we push budgets through. The other big expectation when budgets go through and labor markets slowly come back online is that interest rates will rise and money will flow out of growth, which would be tech and bonds, and into value, so banks and energy. And again, here's a look at what occurred last time we did big spending. The yellow line represents interest rates going up. The green line are energy companies, and the candlestick are tech stocks. Now, what's remarkable is how quickly the stimulus stopped working. So bottom line is we put the fiscal impulse, the inflationary impulse into the economy, but the money was not well used. Very quickly after, interest rates went right back down, energy companies came back down, and tech soared back up. And that's because we're not getting the jobs and economic growth we need for sustainability here. And every month that has transpired since March, the labor recovery has gotten worse and worse. And last month, it was nearly flat at 200,000 jobs when we're supposed to be averaging 1 million. We'll see what happens this month, but with the mandates, walkouts, people refusing to go to work, I don't think we're going to have strong labor data for the rest of the year. So we'll see how this plays out. All right, so that is the long and skinny of it. Again, if you're on a free trial and you don't want to miss out on trade alerts, or you're catching this on YouTube because you're expired, call John right now, 505-610-1334. If I predict a stock crash is coming, you're going to want to know when that happens and exactly how to adjust your portfolio to lock in all the gains from this year and last, and potentially make a lot more money on a volatility event. You can get a year's worth of profit in a very short period of time if markets get volatile, if you know what you're doing. And we'll show you a safe way to do that. Okay, very good. So we're going to go ahead and jump into some content here. Okay, so let's start off looking at the boring old yield curve. Same basic shape. It has not inverted yet. So let's just explain how to read this thing. So on the left, we have 0%, 0.5%, 1%, all the way up to 2%. That's the interest rate you get paid to loan the US government money. On this axis, we can see how long you're going to loan the government money. So if it goes inverted, you're going to make more money with a short duration bond or note or T-bill. And so that typically spells problems in the economy when that occurs. Now, what do I see with this? We see the short duration T-bills are suppressed extremely low, showing extreme demand for those products. Primarily, it's banks who have more money deposited than they've ever had in history. So they have a problem is that they have to pay interest on those deposits, and they want a safe way to do it. So they're fighting over the T-bills. What people are less interested in, and you can see the dots just start to jump higher and higher, is loaning the government money for prolonged periods of time. And that's because you should get a higher interest rate than the level of inflation. And we're running at 4% plus inflation. So tell me, why on earth would you want to get paid 2% for 30 years? Well, you don't. And that's why the Fed has been buying up our own debt to keep these rates lower. Because without those forces, the most likely outcome is rates would rise until they created a stock crash and then completely crush the economy and labor market recovery. So that's why they do QE, is because they need to suppress these interest rates from becoming too attractive. So very interesting. And we'll be looking at reverse repo to predict when this could have problems. Okay, now we're looking at the VIX futures term structure. So this is a bet on volatility for each month. And what we're interested in is which months have a bigger change in price. And you can see it's clearly November through the start of January. After that, the dots are relatively not jumping as high. So the market risks are clearly tapering, may not be favorable for equity markets, which is going to be potentially announced November 3rd. And then if the budget's not passed in November, get ready for a crash into December. That's really how I read this chart right here. Now, should we get worried about interest rates spiraling out of control anytime soon? No, right now the reverse repo is at $1.4 trillion. So the banks are desperate to find government debt products that pay interest so they can service deposits in the trillions of dollars. So if this starts to fall, that's what will trigger a sell alert for our tech position to at least reduce exposure. So right now it's at 1.4 trillion, and it's been trading between 1.4 and 1.6 for the last week. So no reason to believe interest rates are about to spiral out of control. This is just a good look at how interest rates affect markets. And so again, if the interest rates rise in the gray line, we can see NASDAQ sold off and NRG went parabolic to the upside. Then we had interest rates fall. NRGU got beaten with a club. And you can see tech stocks went up. So it's really smart to have both and to adjust the ratio based on what you believe is going to happen with interest rates into the future. So without the government expanding debt, I'll tell you what's going to happen. Interest rates are going to go lower. And if they do expand the debt, interest rates will go higher. That's really as simple as it is, and how to be positioned. So what's the market predicting here? Clearly, it is predicting that the government's not stupid and that they will pass a budget. And that's why we have interest rates rising and NRGU taking off. So we will see. They are having some troubles. All right, Russell 2000 is IWM. It's been trading flat since February. This is a great way to predict markets. And again, is it going to break to new highs? I believe with stimulus, it will, and the market melts up into next year. That's how we're currently positioned. Here's a look at emerging markets. This has been in a downtrend since February. Is getting ready to reverse that and march higher. I believe once again, if we can pass budgets, it is absolutely going to break new highs, and a beautiful time to get into that. We know that China has been taking advantage of their situation to improve their economy in the long run in the face of great strength from massive amounts of demand for their manufacturing. So I say buy the dip. Okay, here is Europe. This is what Jeffrey Gundlach's been big on. By the way, Ray Dalio has been pushing everybody to Asia. We've actually seen Warren Buffett start to buy Japanese, and Charlie Munger doubled down on Alibaba. It was a headline a few weeks ago. But meanwhile, we've got EFO, great index, gives you some huge companies like Louis Vuitton, a bunch of big banks. You get Toyota, all sorts of companies. But it's really set up for an inflationary environment, which is exactly what I believe we have for quite some time ahead. So again, everything is really waiting for the US government to confirm it will continue to expand its debt, which inflates financial assets. Now, if you're in our more aggressive strategies, bootcamp core, you're betting big on Bitcoin. And if you're in the high risk strategy, you're betting big on Ethereum. And so in this chart, we're looking at the relative returns. And for a very short period of time here, we actually had Bitcoin outperforming. In general, I would tell you Bitcoin will lead the move up, Ethereum will come in second, and altcoins will come in afterwards. And so that's exactly what's happening here on all this news of the Bitcoin futures product. We're seeing a bit on silver and gold, actually a really interesting relationship I saw in another chart. Let me just go ahead and overlay that. I'm gonna go ahead and hide silver and add GBTC. We've actually been seeing a little bit of a reverse relationship. So when Bitcoin was going up, gold's been going down, and when gold's been going down, Bitcoin's been going up. So how funny is that? That makes no sense at all, but that is the trend we're starting to observe. We have a good chunk, about 10% long gold in the Safe Alpha product, just to kind of make it less boring, because we have that huge NASDAQ position and the huge energy position. So we have a little taste of Bitcoin and a bigger taste of gold in that portfolio. In Pro, you have a taste of Bitcoin and a slice of silver. So long-term setup for gold and silver is really beautiful. I'm a big fan of those positions, but they have not been performing as you might have thought. Perhaps it has to become clear that we're entering a stagflation period for gold and silver to really shine, and that Bitcoin and Ethereum seem to be acting more like a growth tech stock. So that does seem to be the relationship and trend that we're starting to see. Okay, if we're going to get a crash, we have 3 easy plays for you. UVXY is the most important, the only one that could give you 10 to 20 times your money in a very short period of time. You got to be nimble, you got to be quick, you got to know when to buy and when to sell, because this decays at 2% a week. Treasuries, TMF. Okay, if the government's going to hit another debt ceiling crisis December 3rd, there's going to be a massive short squeeze. There's a huge, massive short position in treasuries betting that rates go up right now. If they fail to pass a budget, that's going to get short squeezed, and you're going to see an epic run up at TMF. No way you're going to make 10 times your money like UVXY, but we could certainly make a double or triple on that. And then the least aggressive bet on a crash would be betting on the dollar against the euro with EUO. It's just really a good place to put capital and make perhaps a 30 to 70% return in a big crash. And again, the least risky way to bet down on the markets. So those are the 3 plays, the only 3 plays that make a whole lot of sense, and where we would shift capital to if we get more nervous. Right now, we're not pulling that trigger. I think we continue to melt higher until the very last second. Okay, now in Bootcamp Core, we have a few bonus plays. Uranium, we've been in and out of. We missed a lot of this year's run up. We were hoping the MJ would be the better play, and that was not correct. I do think the stimulus will throw some bones to that space. So I'm being a little more patient on that one. I probably will reduce some of our tech exposure into uranium as soon as we get closer to passing stimulus. So I do want to get into that play. We're not in COPEX right now, but there's a huge shortage of copper coming in, so I do want to get that back on the table soon. REMX is your rare earth metals for lithium, cobalt. Tesla and Apple alone are going to drive REMX higher for decades to come. In about 5 years, it's clear we're going to have a massive, massive problem of not having enough of these metals. So especially if the globalists maintain control of governments globally and really drive us to a world of no carbon emissions, then you're going to make an absolute fortune on REMX and COPX. And then I think the reality is, without nuclear power, there's no way to get to these carbon goals that they have. TAN will be a great one. That's solar panels. But again, you're going to need all of those in great quantity to get anywhere near these neutrality of carbon emission goals they have. Okay, F and GU, we're playing instead of the triple Q, gives you Alibaba and Baidu, and then 10 huge US tech companies that have the majority of call options, creating gamma squeezes. So those are the additional plays. You can see all of these are doing really well this month. We've got F and GU up 23%, uranium up 16, COPX 10%, REMX 9, TAN 8, and then that's compared to the SPY at only 4.5. And then MJ being a big dud. Now MJ, I want to warn you, tends to spike out of nowhere and look completely depressing until it suddenly gets stock promotion. So I wouldn't give up on it just yet, and the stimulus deal could do the trick. So for now, we'll just leave it be. Okay, here's that DXY. We did decent with the dollar rising. The second the dollar began to fall, we had some of the best returns in our history. You pass some more stimulus, this dollar is going to fall even further. And I think we should start to readjust the portfolio as we approach 90, which I think could be happening towards the end of March. That means your oil play and your Bitcoin and Ethereum play goes parabolic. Okay, just absolutely parabolic. That's how we can hit $100 oil and we can hit $100,000 Bitcoin. We need that dollar to fall towards this level. I do believe the Fed will protect the dollar once it gets to that level. So expect to tighten up the ship if we get towards that level. Here's the Chinese yuan again, tightening. Okay, we've got all this headline that China's about to collapse and their currency is getting stronger. Makes no sense. So I'm not worried about China at this point in time. Okay, we have covered the cycles there. Now, just some general advice. If you're in crypto, Bitcoin's your most likely success story. Not going to have potentially the best return, but most likely success story. Ethereum has the possibility to overthrow Bitcoin as the largest market cap, but only if it gets mass adoption of software development and user growth. Okay, right now, all that's really been successful for Ethereum has been Uniswap and these NFTs. Okay, that's not enough. They need to start actually ripping off all the products and services that exist in our centralized world and gain massive user growth. To do that, they have to switch from proof of work to proof of stake, which is not necessarily proven to be highly secure like proof of work is. So a lot of risk, makes a lot of sense to own both Bitcoin and Ethereum. Now, furthermore, half of the people who put Ethereum on the board have left the company, if you want to call it that, and have started their own. And that's Cardano and Polkadot. And then meanwhile, a massive venture capital firm out of San Francisco is putting hundreds of millions of dollars behind a company called Solana. So you want to hedge Ethereum with Bitcoin, but you want to also hedge Ethereum with Solana, Cardano, and Polkadot. So those are where I would really be focusing your cryptocurrency exposure. Everything else is really noise. If one of these projects doesn't become extremely successful, it's highly unlikely anything else in this space does well. So that's why I focus that for our private equity offering called Rebel Dividends. We're just focusing on the most important technology that must become successful for this space to remain legitimate into the future. So that's how we're looking at the crypto space right now. Now here's a look at the relative returns we've seen on some of these. This is specifically what we have in our Rebel Dividends private equity offering. So NRGU's done excellent. That's a hedge against interest rates, assuming that we should think of these cryptocurrencies as tech stocks and that they're not going to be very fond of interest rates rising. So NRGU is the hedge against interest rates rising and the bond market creating volatility in long duration assets, which would be TLT, the QQQ, and I would argue cryptocurrencies. Now we know what happens if interest rates rise too much. It will crash the economy. So we know that these are short-term risks and that the Federal Reserve will likely step in anytime rates rise too much and go into more aggressive quantitative easing, which again is what in general drives these assets higher. So we're really set to jet for the next several decades in these. I see very little risk outside of short-term volatility events due to monetary policy trying their best to fight inflation while having massive problems in terms of trying to figure out how do you put everybody to work and create a robust economy. And that would actually be what would make me get bearish long-term, is labor force participation in the US starting to rise. To do that, you'd have to bring back manufacturing. You need a very populist agenda, not a globalist agenda. And we'll see if that changes politically after the midterms and 2024 election. So we can see Polkadot up 66%, Solana 64, Bitcoin 49, Polygon, a product I like, a layer 2 solution for Ethereum and a bridge between Binance and Ethereum at this point, but soon it could be bridging more ecosystems together. Ethereum up 43, Pancake Swap, which we like. It's the DeFi for Binance. It also pays out a massive staking reward of 72% a year. So think of that as a stock with a dividend of 72% a year. And then Cardano up 9. So that's a look at our favorite cryptos week over week. Okay, so the medicine is very short-lived. This is absolutely clear. What it does for you is like step 10 in a 10-step process for your immune system. So it's skipping the first 9 steps that give you a long-lasting, robust protection against future infection, and it's giving you about 90 days. So I believe, and this was a new headline yesterday, Moderna and Pfizer have predicted they'll double revenue next year. Double the, so clearly they believe you'll be required to take boosters. They're saying every 6 months, but it may have to be more often than that, which is probably going to piss off a lot of people because that's not how that was advertised. But yeah, the data is very, very clear now. So we'll see how this plays out. But I would be very surprised if we don't have overloaded hospitals with people who took the medicine primarily by December. So could this be used as political ammunition for a lockdown? Possibly. Now, we had a good idea that this would be the case from Israel. They got the medicine double dosed by February, and then 6 months later came in and wham. So this disease is very seasonal, based on weather and humans coming into close contact, which is affected obviously by the weather. So the United States trend is for this to become a problem in the winter. Now this is Singapore again, the highest, one of the highest. I think they're in the 90% of people have taken the medicine, and now it's spiraling to record highs. Not every country that has a high medicine uptake has this chart, but the point is quite a few do, which tells us there's very little correlation to a high uptake and stopping the transmission. So this is, in my opinion, very easy to predict coming up. Now the rate of change has been crashing. That's our seasonality every year for these types of infections. But get ready, because by the end of November, the pattern is it skyrockets up. We actually get about 3 times the infections in December than any other part of the year. Which is funny, when we used to be in the weight loss marketing business over a decade ago, you made all your money in 1 month. The rest of the year, no one had any interest in that. And here's a look at that chart. So this is, again, what I'm anticipating is that we should suspect that the cases fall until October, and then slowly start to rise early November, and then rocket ship up into December when it gets really cold. So we'll see if this plays out and if it's used to help push the budget. Okay, it's the UK now having cases rocket up. This is hospitalizations. I'll have to update a page for, okay, here's India. Let me just switch this out to UK. So this was looking good at first because they did their independence opening July, mid-July, and the cases fell. And then you go about 90 days later after the second dose, and what do you know? Now everybody's getting sick. So we'll see if this is going to slow down. But again, just more evidence that high likelihood of infections this winter, which could be used for lockdowns and dramatically affect the economy. Okay, in this chart, we're looking at interest rates relative to oil. Typically, these two are very, very correlated. And as you can see, oil predicted the crash way before the crash occurred last year, right here. So you can see it crashed in January, February, and then boom, markets took note once we went into lockdown. This was, of course, due to Asia locking down, then Europe locking down, and then the US. And it actually pushed oil negative for a split second there. So what have we seen lately? We've seen these start to really diverge. You can see rates have been suppressed lower from quantitative easing, Fed buying up our own debt, keeping the rates lower at the fastest pace in history for America, and then oil going the opposite direction. So if the Fed wants to taper, the initial reactions likely rates rise and growth to value rotation. Once the rates become unsustainable, then you get a stock crash and likely take energy down first. Okay, some other commodities or metals we're looking at. So we got natural gas, took a little breather, but still extremely elevated. Dr. Copper jumped after trading flat, a little bit of a pullback here, but in general, the inflation looks like it is not transitory. Here's lumber futures, which went just nuts all year, then had this epic crash, and now it's coming right back up. So just since the 23rd, it's up 48%. Just mind-boggling what happens when you print $12 trillion globally in a year. Okay, the Baltic Dry Index is another measurement of shipping, which is another way to look at demand in the economy, inflation in the economy, and it's still at record levels. We've got some 122 ships parked out of California. There's rumors that there's been regulations that make it very hard for the truckers to pick up the cargo. So some interesting data I'm researching on that. Here's a look at rates long term. So for much of our investing careers here, we've seen nothing but rates go lower. Now, unfortunately, this doesn't show you the 70s, but the 70s, you had unsustainable, you had relentless inflation that would not go away for a decade, and interest rates went all the way up to 16. Okay, then you get Alan Greenspan come in, and Ben Bernanke, Janet Yellen, Powell, and all they've done is push rates lower, print more money faster. And so are we about to head into a new regime? That's the big question. So politics will be important. But I would believe without a robust labor market recovery, it's going to be very hard for them to raise rates without sending the US into a Great Depression. So I think we have one more big cycle to low or negative rates, and that we're going to see this rise to as high as 3 maximum before we head towards 0, like we've seen in Europe and Japan, because the only other option is not going to be popular with voters. You'd have to balance the budget, take away everybody's free money, and no one's going to vote for that. So that's where I would aggressively buy US debt, is after we break this recent high of 2.4 and realize we have no idea what will crash the economy, but it won't be much higher than 2.4. I'd be very happy to begin building into this position and hold a loss, because we know eventually it's going to get crashed and cause even more QE and crush those rates lower. So as soon as we break 2.4, I'll start to build us a position, and we'll get very, very aggressive the higher it goes, with a belief that 3 would be the maximum. Now, in the very short term, again, I like treasuries if we can't extend the debt ceiling and pass more spending, because that would create a short squeeze and we could see these rates go lower before a new deal's passed. So very interesting development there. This is called Dr. Copper. You take the ratio of gold to copper prices. Typically, if you have stagflation, people invest in gold. And if you have a robust recovery, you build things with copper. So that's the logic behind it. And you can just get a feeling for how dramatic this can occur from 2002 to 2006. And so as long as we recover the economy, I would anticipate rates rise like this. Now, the policies I'm seeing are not so bullish for labor. So we'll keep a close eye on that labor data. Okay, here's the 3 critical bond markets: TLT, LQD, JNK. TLT is your government bond, long end. LQD is investment grade. So that's what funds the stock buybacks for Apple and Microsoft. And you got JNK, which keeps all these Russell 2000 companies alive. We're going to be worried if they're selling off because rates are rising, and believe that could create volatility in stocks. They're not, so nothing to freak out about here. If anything, their rates have been going lower. So nothing to freak out on that space. This is where we track the debt coming in, so we can watch the treasury auctions. Now, if reverse repo is at 1.4 trillion, I don't care how much money Janet Yellen wants to dump into the auctions. It's telling us the banks need more debt and will buy it at whatever price because they're desperate to have a safe way to pay interest on deposits. So that's what this chart is and why we watch it. Okay, so we've had a few good months of payroll growth. Okay, we've had let's just say we've had 2 prints out of million, but every other print has been much lower. And so we really need to get back to at least 500,000 jobs a month and minimum to believe that we can raise interest rates and taper bond purchases without a huge economic crisis. So I don't think we're going to taper November 3rd with all the risks coming from uncertainty in fiscal policy. We won't know the labor data for October, but it's likely terrible due to mandates and supply chain issues slowing the economy, and then all the uncertainty out of China. I just don't buy it. Plus this really bad print here. So we did have Powell say, hey, it's time to taper. So we'll see if they really pull the trigger on that. Now, if they do, you're already positioned for that, for the knee-jerk reaction from growth to value. So we have nothing to change for the November 3rd, unless we think the tapering is going to create a stock crash, which at this point, I don't think it will right away. Okay, here's the inflation. Jeffrey Gundlach was on CNBC today saying we're not going to see this go below 4 for next year at all, unless the Fed obviously tapers and hikes rates, which again would crush the economy. So they're very unlikely to do that. Bank credit keeps growing. That's very good. That's exactly how we're positioned for. Consumer credit continues to grow. Again, that's how we're positioned. Retail sales continue to grow. That's how we're positioned currently. Consumer spending just hit a record high, exactly how we're positioned. The fear is that all of these data points start to reverse. Job openings fell a little bit. That's good. That's showing some people are coming back to work here. Producer prices going up is not good. That means inflation's continuing, which could eventually start to compress profit margins. Jobless claims down a little bit. This needs to go sub 200,000 to really become impressive. So still nothing to get too excited about there. This is what's going to keep the inflation sticky. Wages are rising now and rent is rising now. So expect that CPI to stay hot for quite some time. Now, if we're going to have a 70s-like inflation problem that is relentless and forces long-term rate hikes, likely you need to have labor rising And so we've only had that from 2016 to 2020 in the last 2 decades. And again, that was a populist agenda to deglobalize supply chains and bring manufacturing home. And you can tell the powers that be do not like that policy. They like the way things are currently and don't want it to change. So I find it extremely unlikely without some sort of revolution in governments to see this rise, which is what we were starting to see. It was populist movements spreading like wildfire globally. And I do believe what we're facing today is the response to that, to put out the fire. Okay, balance of trade keeps going further and further into the hole as the deficits grow. This is net negative on the dollar, how we're positioned. Personal income, there's a new print, 0.2. So a lot of people thought with the benefits ending that the personal income is going to fall off a cliff. So far, not the case, but it's only been about 3 weeks now. Companies keep a close eye on. Apple, nothing to be concerned about there. Tesla, boy, oh boy, new high. Elon Musk owns 25% of Tesla, 50% of SpaceX. Now the richest man in the world, valued at $250 billion. So I know Mike Fisher had a big Tesla position. I told him not to sell it, so good for you, buddy. As soon as the stimulus passes, I'd anticipate you should sell your Tesla because that was what will make the rates go up. And again, look at what happened last time we passed stimulus in February. So it did okay with the December print, but boy, oh boy, once those rates went up, you got this massive crash in Tesla. So I would actually even consider this being a superb way to protect your portfolio with put options soon as, again, you pass the stimulus, you get those rates rising and you get labor coming back. For now, I wouldn't touch it. Probably going to go higher. Okay, poor Kathy Wood sold all her Tesla, now underperforming the market. This is a hugely overvalued, oversubscribed ETF. In my opinion, that's extremely sensitive to rates rising and could create systemic risk in markets so far. It's hanging in there. Tencent, massive Chinese software company, critical for EDC, stabilizing. These guys own basically every app, every phone app that Facebook doesn't own, Tencent pretty much owns. So those are the giants in that space. Alibaba doing really well since the Charlie Munger headline hit. Again, we're looking at these national champions that just can't crash. Samsung's probably your most bearish national champion out there right now. Just keeping a close eye on that. We have had some pretty nasty earnings on some of the tech companies the last few days. So Netflix, subscriber growth, profit margins were down. IBM crashed. Snapchat's having some issues. Twitter's having some issues. But in general, nothing to freak out about with the ones that we're tracking. Toyota's still hanging in there, getting ready potentially for a new high. China's PMI, which had gone below 50, which is negative, is back above 50. Looks like they're starting to print money to stabilize their economy after trying to pop some bubbles. We got European PMI still in positive territory. This is probably your best measurement of demand of global economy is the Chinese imports, record levels of imports and exports. Never been better. Okay, as far as central banks, let's see if we're still printing, and the answer is obviously yes. So boy, oh boy, Fed just hit a new high yesterday. Every Thursday you get that update. So $8.5 trillion. And just let's see, before the crisis, it was at 4.2. Europe's still printing away, although at a slower pace, and Japan has slowed down, but we do know China is starting to print. So that's a good look at the markets. Let's hit some news headlines. Okay, Joe Biden says climate change is an existential threat to humanity. That's why I'm making a commitment to get net zero emissions on electricity power by 2035 and net zero emissions across the board by 2050. So of course, that's exactly Bill Gates. I think Bill Gates is pretty much running the show right now in his group of buddies. US budget deficit hits And again, if this agenda is really going to play out, some of those smaller energy plays that we have in bootcamp core are going to just do really well. REMX, COPX, URA, and TAN are my favorite plays for trying to get net emissions to zero. But to get there, you're going to drive oil sky high. So NRGU also, funny enough, probably your best returner in the short term compared to all these others when you're trying to hit this goal. US budget deficit hit 2.7 trillion in 2021 after a record of 3.13 trillion. So when they say fiscal cliff, they're talking about this deficit dropping too quickly year over year. That's what everybody's freaking out about, and why Janet says you need 6 trillion in spending to avoid a big problem next year. So the budgets they have will get us through at least Q1, maybe Q2, but after that, you either need lots of economic growth and labor recovery or more spending. So we'll see how this plays out as we approach midterms. Gunlack says he switched to European stocks months ago today, and that CPI will be above 4 for all of 2022. Starting to see some of these walkouts win in terms of the mandates. Interesting to see how that's playing out in terms of labor recovery. Gunlike says the dollar has peaked, going to go down, which I agree long term. We just have this risk of it spiking if we can't pass a budget. But yeah, that's how we're positioned long term. Swaps market are pricing in a 70% chance of June 22 Fed hike. That probably won't go over well unless, again, you've recovered a lot of jobs. Powell was on TV today saying it's time to taper. This is not a situation that our patient approach of framework was designed for. So they're freaking out about the inflation. We're still 5 million jobs below the high. So that's what they're stuck behind. Fed's Powell, I do think it's time to taper, not time to raise rates. Grocery stores in some parts of the country are putting up paper pictures of products because the shelves are empty. I'm still digging into why can't they unload the ships off the coast. Something I read was saying that Newsom had put a law into effect that the trucks have to be less than 3 years old, otherwise they don't qualify, creating this huge shortage of trucks. And then there's, a lot of upset folks that Pete Buttigieg is on maternity leave, who's in charge of transportation. So is this an uncontrollable problem, or was this being done on purpose? So I'll let you make your conclusion there. I'm not sure at this point. Having a surge in Germany now. So US typically has been about 12 to 16 weeks behind Europe for trends. So that, again, lines up to exactly when we're predicting problems coming up. Right now, UK Prime Minister Johnson says he's not suggesting a lockdown right now, but they're seeing those cases rise. We'll see how that plays out. This is saying that energy going up is a late cycle move. So we can see crude prices end up crashing markets. And you can see how it went parabolic here and created the housing crisis. And then went up till about 2014. Now it's rising. So again, I think we got a long ways to go before we crash. I'd say oil hitting 120 is going to get me nervous. 150, I'm out. I'm also looking at the price of ExxonMobil to break 95, maybe break into new highs. We'll start scaling back on that, believing again that the inflation will lead to a deflationary shock as consumers can't afford the rising costs. In UK, if you have double dose and you're over 30, there's simply a much higher rate of infection per 100,000 people. That's just because people who've had the medicine believe they're safe and they're taking more, whatever it is, it's just not working. So this, again, leads us to believe that there could be a problems this winter in the medical system. Here's the approval and disapproval rating. This is making it harder to pass the budget. So again, down to a 26% approval rating and a 63% disapproval rating. I'm not sure what poll that was, so I'll have to look that up next time. Here's a look at the cargo stuck outside of California. What is causing this? Why can't they unload the cargo? The best explanation I've had is there's all sorts of rules saying the trucks have to be less than 3 years old and there's not enough of them. So we'll dig into that more into next week, but this is definitely becoming a problem for earnings if we can't get the goods to the stores. Walmart's rolling out Bitcoin ATMs across 200 stores nationwide. Guess what? Pfizer says booster restores efficacy to 95%. And they're expecting twice the revenue next year. Trump launched DWAC. It went from 16 to something crazy. Let's see, it's at, I think it hit like $200 today. Hold on. This is supposed to be a free speech Twitter competitor. 93. Oh boy, it did crash quite a bit, I think. Let's see. Okay, so it went up to about 140 or so. 160 was the high, currently at 93. So wild move on that. Don't have any opinion on that. Manchin's been threatening to become independent and support the Republican Party. So there have been, I think, 2 instances in the last several decades where the Senate has flipped the majority due to something like this. So very interesting. We'll see how this plays out. I do not have a great read on to whether or not they're going to pass a budget. I think they will, but we're ready if they don't. The long view says earnings season's getting nasty. Facebook down 5, Intel down 9, Snap down 25. Peter Thiel says on Bitcoin's move, it surely tells us that we are at a complete bankruptcy moment for the central banks. Cinema is keeping that tax rate lower, good for stocks and business in the US. But again, making it hard to pass this new bill. Okay, good. That does cover the most important headlines, I believe. And then Manchin's seeming like he wants 1.5 trillion to be the top price for 10 years, not 5. So yeah, that's just not having the progress that they need right now. Okay, very good. So just a quick little clip. This is where the video ends. If you're not a paid member, you're not going to get the trade alerts. You're not going to see the breakdown of assets. So don't miss our next trade alert. Call John at 505-610-1334. So you can upgrade and gain access to the membership area. In the membership area, you can punch in how much money you have into any one of the 4 strategies, and it automatically calculates what to buy so that you can get positioned for what's coming next. Okay, very good. So we're going to jump into the paid member content now. Okay, so just a reminder, the products we like are UVXY, TMF, EUO, maybe a slice of silver. If we're not 100% sure